Welcome to the Explainer. You know those giant buildings that make up our city skylines? Office towers, shopping malls. We're going to tackle a huge question today. How does anyone actually figure out what they're worth? Let's dive in. I mean, think about it. It's a real puzzle, right? It's not like a stock where you can just look up the price on your phone. Every skyscraper, every mall, it's totally unique. So where do you even begin? How do you put a price tag on something that's one of a kind? Well, the answer actually starts with a really simple idea, and it's something you've probably done yourself anytime you've shopped for a home. You know, when you check out what other houses in the neighborhood sold for? Yeah, if you've done that, you're already thinking like a pro. So that common sense idea, it actually has a fancy name in the world of real estate. It's called the principle of substitution. And trust me, it is the foundation for everything we're about to talk about. And really, it's just pure, simple logic. I mean, why would you pay $2 million for a building if you could get a nearly identical one right next door for $1.5 million? You wouldn't, right? And that super simple but powerful idea is the engine that drives the most common way to value these properties. The pros call this the sales comparables approach, or let's be real, everyone just calls it sales comps. And it's all about answering that one big question. What are similar buildings actually selling for on the open market? It's like the ultimate reality check. Okay, but to do this like a real pro, you have to go way beyond just looking at the final sale price. You've got to speak the language of commercial real estate, or CRE. So let's crack open that professional toolkit. So here's a really key concept. You can't just compare, say, an apartment building to an office tower using the same ruler. It just doesn't work. So what pros do is they use a specific price per unit for each type of property. For apartment buildings, they look at the price per door. For an office or a retail space, it's all about the price per square foot. And for hotels, it's the price per room, or per key, as they sometimes call it. This is how you get a real apples-to-apples comparison. All right, here's the other big one you have to know. The cap rate. Just think of it like a quick snapshot of a property's return on investment for a single year. It's pretty simple math, actually. It's just the building's annual income divided by its sales price. And here's the key takeaway. A lower cap rate usually means investors are willing to pay a higher price for that stream of income, probably because they think it's a safer bet or has more room to grow. Okay, so we've got our metrics, our yardsticks, but Here is where the real art comes into play. Because, let's face it, no two buildings are ever perfectly identical. And the true skill of a great valuation is knowing how to intelligently adjust for all those little and big differences. First up, you've got the building itself. You have to adjust for all the physical stuff. Is it an older building? Well, that's probably a negative adjustment. But hey, does it have a brand new lobby or amazing parking? That's a positive adjustment. Even the size can make a difference. Sometimes, ironically, bigger buildings actually sell for a lower price per square foot, because of economies of scale. And then, of course, you have the big one, location, location, location. A building sitting in the middle of a bustling downtown is a completely different animal than one out in a quiet suburb. Appraisers have to weigh everything. How visible is it? How easy is it to get to the highway? What's the neighborhood like? And is it growing or shrinking? And this is fascinating. You even have to adjust for the deal itself. Think about it. A sale that happened 6 months ago. You might need to adjust that price to reflect what the market is doing today. And a building with a rock-solid long-term tenant is obviously worth more than one that's half empty. Oh, and if a comp comes from a distressed sale, where someone had to sell fast, you pretty much have to throw that one out. It's not a reliable comparison. So as you can see, the sales comp approach is super powerful. I mean, it's rooted in what real people are actually paying for stuff. But it's not perfect, not by a long shot. So let's do a quick reality check on the good and the bad. Look, its biggest strength is obvious. It's based on real-world actual sales. That makes it pretty easy to get your head around, and it's a fantastic way to see what the market is thinking. But the weaknesses are just as real. Sometimes there just aren't enough recent sales to look at. And if you're trying to value something truly unique, like, say, a massive data center, well, good luck finding a similar property that just sold. So, the big question is, how does an appraiser take all this messy data, all these different adjustments, and boil it all down to a single value? Let's walk through that final process. It really comes down to a clear 4-step process. First, they hunt down the best possible comps, usually 3 to 6 of them. Second, they have to verify every single detail of those sales. Third, they do all that hard work of making the adjustments we just talked about. And finally, they reconcile the value. That just means they weigh the best, most similar comps more heavily to land on a final value or at least a tight range. So you see, using sales comps isn't just about crunching numbers to find a price. It's more like reading the market. It's about understanding the story that buyers and sellers are telling with their wallets, about what they think these buildings are worth right at this very moment. But, and this is a huge but, there's a critical catch, and this quote really hits the nail on the head. The whole method is, by its very nature, backward-looking. It's all based on data from the past. It can tell you with incredible accuracy what happened yesterday. And that leaves us with one last really important question to chew on. In a market that's moving fast, with interest rates jumping around and what people want from buildings changing, is looking backward really the best way to see what's ahead? That's the central challenge in all of real estate valuation. And it's definitely something to think about the next time you find yourself looking up at a skyscraper.